So, welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals today, once again. In front of your screens, you have your USD's daily chart. All charts will be presented out to be of the same time frame, but we may have to drill down into other time frames in order to get more, I would say, detail regarding a trading instruments movement. By the way, feel free to propose any trading instrument which we offer and you would like to have a look at. If we do have time today, we'll do it today. If not, we can always do it another time. Now, the fundamentals related to the markets, okay, definitely the hurricane in the US and Tampa Bay is a big issue. I think that market-wise, the main release, which was closely watched by market participants, was the release of the Fed's meeting minutes yesterday. They were for the September meeting. Now, the release as such, or the document as such, did not provide anything substantially new. However, I would say that more or less it verified that the Fed's expectations about an easing of inflationary pressures were verified, or at least Fed policymakers felt that way. And but one could expect that after such a conclusion, the Fed would be expediting its interest rate cutting. It actually, in my opinion, tended to imply that given that the Fed's forecasts were, I wouldn't say correct, but are in the right direction, then there is no need to actually expedite the interest rate cutting, is there? And that tended to provide some slight support for the USD at the time of the release and a few minutes later. I would be also noting that we had San Francisco Fed President Daly speaking yesterday. Now, she stated that she sees one or two rate cuts to come until the end of the year. And in my opinion, that was slightly more hawkish than the release of the Fed meeting minutes. As she sets one rate cut into doubt. Overall, though, the market expectations, remain firmly in favor of two rate cuts of 25 basis points each in the following two meetings until the end of the year. The big question now is the CPI, and I'm highlighting this for two reasons. Okay, definitely one reason would be that on a macroeconomic level, we have already had the US employment data for September last Friday with a stronger than expected employment market. I think that the inflation data is going to be another big piece of the puzzle. And the second reason I'm highlighting the CPI rates is that they do have the ability under certain circumstances to actually shift the market's expectations to either side, depending on the outcome. So for the time being, we're highlighting that the headline rate is expected to slow down from 2.5% year-on-year to 2.3% year-on-year, which would be in line with the Fed's narrative that inflationary pressures continue to ease. My worries are focused practically on the core rate. Why? Because the core rate is expected to remain unchanged at 3.2%. And at a core level, there seems to be no intention of inflation to actually slow down. However, we may be seeing different actual rates than what they are expected and the expectations. And should we see the two rates actually aligning into pointing towards easing inflation, and that may take a substantial bit. Then we may see the US dollar weakening. On the flip side, and that would be taking the markets by surprise, should the rates fail to slow down, implying a resilience of inflationary pressures within the US economy, I wouldn't be surprised to see the US dollar getting asymmetric support. And I wouldn't be surprised to see the market expectations for 225 basis points rate cuts by the Fed until the end of the year being reduced. On a technical level now, against the euro, now we once again mention the M formation. Despite some hesitancy on Monday and Tuesday, the pair yesterday dropped and continued to do so during today's Asian and early European session, actually now aiming for the 1.0915 support line. The M formation is in works, and should the pair bears, be able to breach the S1 1.0915 clearly, possibly even using it as a resistance line, then the path would be clear for the 1.0790, more or less in a closure for the M formation, which we have noted, which started around the early days of August. You can see how the pair was on the rise, hit the ceiling, corrected lower. Note the level at 1.10, which is now the neckline. Rose once again, hit the ceiling at the 1.12 once again. It was hit here and here. And then downward motion was maintained, breaching the 1.1110, breaching the 1.10, and now threatening for the 1.0915. For the information to be fully closed, I would require the pair to drop as low as the S2, the 1.0790, which was the starting point. Now, it may not go as low, but overall the direction seems to prevail, the downward direction. And I would be also noting here there is an indicator which has neared the reading of 30. It's actually now at 34.8. And that tends to imply, I would say, a strong bearish sentiment among market participants, even though it has not reached the reading of 30, as low as 30. On the other hand, the key limitations of the downward motion, and they are pretty tight, we have to mention that, are on the one hand the fact that the price action has hit on the lower Bollinger Band, which may slow down the bear somewhat. On the flip side, though, note how the price action is testing the downward trend line, and should the downward trend line be broken clearly, then we may be changing our outlook. Should the price action break the mentioned downward trend line yet remain within the spectrum set between the S1 and the L1, then we would be talking about a possible sideways motion. On the flip side, should the bulls clearly take over, then I wouldn't be surprised to see the price action of Euro USD rising after breaching the mentioned downward trend line, and I would require a clear break of the 1.10 resistance level. Let's have a look at USD JPY. Now, at this point, I would be noting that USD JPY is on the rise, but there is a key difference in regards to Give me a sec. Okay. Now USD/JPY has been on the rise. That would be similar to Euro USD in reverse. And the reason why I'm saying in reverse is because the base and the floating currency are in reverse position. Say for the US dollar and Euro USD is in a floating position, while in USD/JPY it's in a base position. The main difference though remains today's movement. Euro USD, or if you prefer the US dollar, continued to strengthen against the euro, but the US dollar seems to be correcting lower against the JPY. So practically in today's Asian and early European session, despite expectations, the US dollar seems to be weakening against the JPY. Nevertheless, the bullish outlook is still present, and I'm highlighting the upward trend line, which has been guiding the pair since around the last days of September. But also note how the RSI indicator remains at pretty high levels, at 64, which may allow the bullish movement to regain traction. And if that's so, we may see USD/JPY being able to finally breach the 149.35 resistance line and start aiming for the R251.88. On the flip side, should the bears take over, I would require the pair to drop, break initially the prementioned upward trend line in the first signal that the upward motion has been interrupted, but also break the 146.85 support level. Let's have a look at cable. Now there seems to be some hesitancy among cable bears, and it's characteristic how the price action of the pair marks pretty low, if any, volatility. There is still a very slight downward direction, but the volatility is very low. It's as if the pair is afraid to actually approach the 1.3030 support line. The RSI indicator remains between the readings of 50 and 30, which tends to imply a bearish predisposition on behalf of the market. Yet, I'm not so much convinced. The stabilization of the pair, or the relative stabilization of the pair over the past 3 days, seems to prevail, and I think that would be more obvious in the 1 hour chart. Let me drill into the 1 hour chart. See how the pair remained in a sideways motion and is currently testing, if not has breached, the pre-mentioned downward trend line. Let me refine that. Here you go. So I'm actually tempted to switch my bearish outlook in favor of a sideways movement bias, moving now to the daily chart, and that becomes more evident now. The 1.3030 seems to be able to stop the downward motion, however that remains to be seen. Should the pair actually be able to breach the S1, possibly also the S2, then we would be talking about a continuance of the bearish movement with a possible shift of the downward trend line to the right. On the flip side, for a bullish outlook, the bar is pretty high, and for that to happen, or to merge if you prefer, I would require the pair to rise, breach the 1.3260, and start aiming for the 1.3435. For any pound trader out there, be advised we're getting tomorrow UK's GDP and manufacturing output, industrial output data, and they are for August and could create some volatility for pound traders at the time of the release. It's in the European session the early European session, may I add. Let's have a look at USD CAD. Okay. The intense upward motion of USD CAD is being maintained. Sorry. We're talking about 1, 2, 3, 4, 5, 6. This is the 7th day in a row for which the CAD, the loonie, is losing ground against the greenback. The price action was able to breach the 1.3720 resistance line, not into support. Definitely we have to switch that. Let's go hunting for a new ultimate resistance level, and then we will be talking about direction. Now, there is a peak here. However, I would prefer to go all the way up here, where we had continuous resistance for the pair. Next resistance line would be set at this level. Locking it in. At the 1.411. Could go 1.5. Readjusting the chart. Let's correct the labels, starting with the S3, which is now being placed at 1.3425. The S2 at 1.3610. The S1 at 1.3720. The R1 at 1.3845. The R2 at 1.3945. And the R3 at 1.4115. That's it. Now, we tend to maintain a bullish outlook for the pair. I think that's more than obvious. The upward movement, the fact that the upward trend line remains intact, all of that tends to concur towards a bullish outlook for the pair. I would be also noting the fact that the RSI indicator has reached almost a reading of 70. It's actually at 67.5, which tends to imply a strong bullish sentiment on behalf of the market for the pair. I would be adding a word of caution here, and that would be based practically on two elements. A, exactly the RSI indicator, which has reached the reading of 70, it's nearing the reading of 70, may also be implying that the pair is nearing overbought levels, which more or less may, if not slow down the bulls, it may actually cause a reversal lower, a correction lower. I would be also noting the fact that we're getting similar signals by the fact that the price action of USD CAD has reached and actually breached the upper Bollinger Band. So it may not be over the top, but definitely the upward movement seems to be a little bit overstretched. And a correction lower could be in the cards for the pair. Now, should the bulls maintain control over the pair's direction over the USD CAD, I wouldn't be surprised to see the pair aiming slowly but steadily for the 1.3845. At this point, USD CAD traders should be expecting a double whammy. On the one hand, we have today's release of the US CPI rates, and a possible easing of inflationary pressures may weaken the US dollar, thus causing USD CAD to drop. On the flip side, we're getting on Friday Canada's employment data, there for September. And should the employment data continue to point towards a slack in the Canadian employment market, that could weigh on the Canadian dollar somewhat and allow for USD CAD to advance even higher. So it's a double hit in the following today and tomorrow. And I would keep a close eye on the releases and the behavior of USD CAD over the coming 2 days. Now, we talked about a bullish outlook allowing possibly the pair to continue aiming or to start actively aiming for the 1.3845. What happens in case the bears take over? Now, in such a case, we may see the pair reversing direction, breaching the 1.3720 support line. I would require also a breach of the pre-mentioned upward trend line. And I would also require a breach of the S2 1.3610 before adopting a bearish outlook. Just by breaking the pre-mentioned upward trend line, that does not constitute actual grounds for a bearish outlook just yet. It does signal that the upward movement has been interrupted, but it could end up being a sideways motion. For a bearish outlook, we would require more concrete evidence that the pair is falling. Let's have a look at the Aussie. In a beautiful chart, note how the AUD is weakening against the US dollar for 1, 2, 3, 4, 5 days, but not today. It's as if the pair has hit the floor at the S1 0.6705, and allow me to drill into the 1 hour chart exactly to have a better look, more detailed look on the movement of the pair. See how it has hit the floor here, right here, in yesterday's late American session. Yeah. And stabilized since then. Now the big question is whether it will be able to breach also the downward trend line, or whether the downward trend line will lead it to break the S1 0.6705, allowing for the pair to slowly start aiming for 0.6570. It's a triangle. Normally, I would expect the bearish movement to prevail, but I'm quite worried about how strong the support line is actually. So we may see the support line prevailing in this fight between the two, in this duel, given also that it has provided resistance in the past and support here. So that seems to be pretty valid. It should be no surprise the fact that the support line was able to withhold the downward motion, at least for the time being. Once again, bearish outlook still present, given that their downward trend line remains intact. Yet for that to be maintained, we would require a clear break of the S1 0.6705 and for AUD USD to clearly start aiming for the S2 0.6570. The RSI indicator is between the readings of 30 and 50, yet it's at 42. It's not so bearish, but it still implies a bearish predisposition on behalf of the market for the pair. Okay, for a bullish outlook, For a bullish outlook, we would require the pair to reverse direction breach the pre-mentioned downward trend line, but also breach the R1 0.6820 and start aiming for higher grounds. One could argue, even if we were more conservative, one could also argue that for a bullish outlook to emerge, also the R2 0.6940 has to be breached, and practically the bullish outlook would become very clear once the price action forms a higher peak than this one, because you would have one throw, then a higher throw, then a third higher throw, and should the upward movement be maintained like this all the way up here, then you have the next leg. So practically you would be having an upward movement like this one. So the R2 is actually another prerequisite for the pair to break before adopting a bullish outlook. I'm going to be a little bit more daring here, and I think that a higher peak than this one, I wouldn't say it would be verifying the bullish outlook, but definitely it would be enhancing the possibility of the upward movement. On the other hand, the pair may also stabilize and remain between the S1 and the R1 should the downward trend line be broken. Let's have a look at USD/CHF. On the rise, widening a little bit, shifting a little bit to the right, the upward trend line. The price action has breached the 0.8550, and I would dare to say that it has breached it clearly. It's characteristic that the price action yesterday, despite the slight bullish movement, or if you prefer, despite the upward movement not being as strong, it used the S1 as a support line, as a platform to move higher. Once again, drilling to the 1 hour chart to see more detail. You can see it breaking, reversing, stabilizing a bit, yet jumping higher later on, and stabilizing during today's Asian and early European sessions. Back to the daily chart. We tend to maintain a bias for the bullish movement to be maintained, and I'm basing this practically on two reasons. First is that the price action was able to breach the upper boundary of its past sideways motion. And allow me to color this. Okay. So USD/CHF has escaped the sideways motion to the upside as it has broken the 0.8550 resistance line, now turned to support. We set the next possible target at the R1 0.8750, which is being marked practically by resistance right here, but also support in the past. So the level seems to be pretty valid. On the other hand, to the downside, and should the bears take over, then definitely they would have to breach the pre-mentioned upward trend line, breach the S1 0.8550, and start aiming for the S2 0.8370. Now the 8370 was the prior support line of the sideways motion. Let's have a look also at the Kiwi before we move outside the reels of the FX market. Okay, very strong bearish movement yesterday, which is understandable. A slight correction, however, that could be also in the cards, as the pair is currently aiming for the 0.6045. We tend to maintain our bearish outlook, and we're basing this practically on two reasons. A, the strong downward trend line, which is exactly highlighting the steepness of the pair's drop. The second would be the RSI indicator, which remains well below the reading of 50, more near to the reading of 30. implying that there is a bearish sentiment among market participants for the pair. Should the correction higher be reversed, possibly tomorrow, and the pair once again starts aiming, maybe even breaching the S1 0.6045, then we set the next possible target for the pairs at the 0.5980 support line. It's the S2. On the other hand, for a bullish outlook, we would require the pair to reverse direction, actually to extend its buying interest, breach the pre-mentioned downward trend line, breach also the R1 0.6105, and in my opinion, I'm going to be a little bit more conservative here. For bullish outlook, I would also require a clear break of the R2 0.6150. Okay, let's have a look at WTI. Now, the commodities price fell a bit yesterday, but in my opinion, the main element of yesterday's movement was not the drop as such. It was the fact that the price action of WTI dropped but bounced on the S17140, implying some stabilization of the commodities price. Mind you, we had highlighted this possibility practically 2 days ago when the upward trend line was broken. So we tend to maintain for the time being a bias for the sideways motion between the S171.40 and the R177.85 to be maintained at least for now. Also note how the RSI indicator is just above the reading of 50, implying more or less a relative uncertainty on behalf of market participants for the commodities price next direction leg. Now, should the bulls take over, we may see the price action of oil breaching the R1 0.7785 and start aiming for the R2 83.85. In that case, practically what will happen is that the upward trend line will be shifting to the right. But that remains to be seen. On the flip side, should the bears take over, we may see the price action of oil dropping, breaking the S171.40 and start aiming for the S264.60. Now, in regards to the fundamentals of the oil market, okay, definitely the hurricanes at the US coast, Tampa Bay, are an issue for oil production. I would be also noting the AP and EIA weekly crude oil inventories figure, which were released on Tuesday and yesterday. But the main focus, in my opinion, remains at the Middle East conflict between Palestinians and Israelis. Should we see an escalation, a qualitative escalation of the conflict, with possibly Israel hitting Iranian targets, Iranian hard targets, such as, say, for example, the nuclear facilities of Iran or Karg Island, which is a main oil facility for the Iranians, I wouldn't be surprised to see oil prices getting substantial bullish support, asymmetric support, because that would imply more or less that further escalation. May I remind you guys that Iran has vote response, and that could threaten practically the supply side of the oil market substantially, and the markets, in an effort to discount this in advance, are going to be buying oil ahead of any Iranian retaliation. Other than that, or if you prefer, having said that, I think the market may be remaining sensitive, substantially sensitive to the issue, but at the same time may have priced in some scenarios and is in a wait and see position, how they are going to be evolving over the next couple of weeks. But it could go far, far sooner than that. It could go even tomorrow. Okay, let's have a look at gold prices. By the way, before we move to gold, regarding WTI, we will be issuing a weekly full oil report later today. So if you are interested in oil, have a look out for that. Moving now to golds, this is the forward chart. We had switched from the daily chart on a permanent basis recently. And note how the price action of gold yesterday neared the S1 2600, yet rose in advance. So more or less the possibility of a sideways motion between the R1 and the S1 seems to remain. The RSI indicator is between the readings of 30 and 50. It's actually in the midst of them. It's at 40, but seems to be rising. And should it continue to rise nearing the reading of 50, that would imply more or less that the bullish sentiment of gold traders may be fading away. Sorry, the bearish sentiment of gold traders may be fading away and could allow the sideways motion to prevail. Now, for bullish outlook, we would require the precious metals price to breach the R1 2633. Mind you that the R2 2608 is practically a record high level, and that may provide some hesitancy among gold bulls somewhat. On the flip side, should the pair correct lower, then we may see a bearish outlook emerging, and that would be in line practically with a downward trend line like this. And in that case, we may see the price action breaching the S1 2600 and start slowly aiming for the 2550. Mind you that the volatility we're seeing right here for gold prices is pretty low, and that may be another indication of the hesitation of gold traders to commit to either side of the trade. I think that should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Okay, hi everyone, welcome to today's webinar. For today's session, we are going to be talking about the top candlestick breakout patterns. So let's just go ahead and get started. Okay, firstly, before we get started, as per usual, a risk warning and disclaimer. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just a personal opinion of the author, and the client's investment objectives and the risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We'll start off by doing a brief recap on what are candlesticks, reversals versus breakouts, and then we'll talk a bit about our top candlestick patterns. We'll do a brief recap of last week's topic, which was the top 3 reversal patterns, and then we'll look at this week's top 3 breakout patterns. So if you have any questions, feel free to pop them into the chat or in the Q&A section, and I'll try my best to answer them. Okay, let's go ahead and get started. So to start off, let's look at the anatomy of a candlestick. Excuse me. Firstly, we have the bullish candle, where your high price and your close price is the upper candlestick wick. The body of the candlestick starts from the close price to the open price, which would be the bottom of the body of the candlestick, and then your lower wick comprises just of the low price. Bearish candlestick would just be the opposite, so your high price and your open price would be the same, and your close price would just be at the bottom instead of at the top for a bearish candlestick. And your low price and close price are the same. Okay, so let's talk a bit about price action trading approach. So this basically comprises of 2 different trading approaches, the reversal and the breakout. So let's firstly talk about the reversal. So we talked about reversal last week already. In case you've missed out on that, feel free to, I think we might have recordings since this session is being recorded. So feel free to email IronFX email. I think the email should be on their website. Feel free to ask them for the recording, and I'm sure they'll help you out. So firstly, we have the reversal. Here we have price moving within an ascending trend channel. Here we have a morning star formation. We'll go through a little bit in detail about this formation. But basically, this is a reversal formation, and you can see it's also kind of testing that bottom part of the ascending trend channel. So we're expecting prices to bounce off of that channel and hit towards the upper part of the ascending trend channel. Okay, you can see that's exactly what happened here. In fact, it even pushed above this resistance level from where the swing high is at, pushed above it, and is still continuing within that ascending trend channel. On the other hand, we have the breakout. So here we have the resistance area that price is trying to break through. Okay, so we have this resistance level, which is in line with a couple of swing highs, a couple of swing lows, and that basically makes it an overlap resistance. So an overlap resistance basically happens when there are swing highs and swing lows that respect that area. And these are important because it shows that the bulls and bears of your price basically, any securities price basically respect that level. Okay, and here we actually see this formation again with price breaking out of that huge resistance area. So that is the breakout that we're referring to here. The formation that we see here are the three white soldiers. I'm expecting prices to continue to move upwards since there is a breakout already and there is also this formation here. You can see that's exactly what happened here as well. Okay, now let's quickly get into the different candlestick patterns. So we did go through a couple of them already. And if you weren't here for, okay, we just have a couple people who just joined. Yeah, so we did go through a couple of these patterns in our previous price action series. But I was just gonna do a recap in case you weren't here for that. So let's firstly look at the top three single candlestick patterns. To start off, we're gonna look at the hammer and hanging man. These are pretty straightforward. Basically, if we're looking at a reversal from price moving in a downtrend to an uptrend, we're looking at a hammer where the upper wick of the candlestick is much lower than the bottom wick of the candlestick. Hanging man, of course, would be the opposite, and it would be a reversal from an ascending an uptrend into a downtrend. Okay, next we have the inverted hammer and the shooting star. So the inverted hammer basically doesn't have any bottom wicks at all, and the shooting star as well. So you can see it's exactly the same. Difference would just be the color of the candlestick. Inverted hammer, since it's green, it's obviously a reversal into an uptrend. Shooting star is obviously a reversal into a downtrend. Okay, now we're gonna look at the doji candlestick patterns. Excuse me. So your dragonfly doji is basically this letter T shape. And your greystone doji is basically this upside down T shape. Again, these are reversal patterns. So when you see price moving in a downtrend, followed by a formation of a doji candlestick, we can expect prices to then move in an uptrend. Your gravestone doji would just be the opposite, with price moving in an uptrend and then into a downtrend. Okay, now let's look at the top two double candlestick patterns. So we basically have the bullish and bearish engulfing first. Again, pretty straightforward. We just have a shorter candlestick starting from the end of the second candlestick, or rather, your second candlestick starting from the bottom of the first candlestick. And then price is significantly longer compared to the first one. And that's the exact same for bearish engulfing, just that the colors have switched. Since obviously here we're looking at a reversal from a downtrend to an uptrend and an uptrend to a downtrend, as signaled by the name bullish and bearish. Okay, that's pretty straightforward, I think. So let's move on. Next, we have the tweezer bottoms and tweezer tops. Again, your tweezer bottoms are reversal patterns from a downtrend into an uptrend. So you can tell that the color of your candlesticks are basically, it's pretty straightforward. So your color of the candlesticks will tell you exactly the direction of price. So here we see prices moving in a downtrend. Your first candlestick is red, the exact same candlestick shape with no upper wick. Is moving in an uptrend with price in a green color candlestick. Next, your tweezer tops would just be the upside down of your tweezer bottoms, with price moving in an uptrend at first, as signaled by this green candlestick, and then price then reversing and moving in a downtrend following this red candlestick here. Okay, Okay, let me know again if there are any other questions. If not, let's move on to the top 3 triple candlestick patterns. Okay, firstly, we have the morning star and the evening star. So your morning star is basically a bullish reversal. Price is moving in downtrend. We see this longer candlestick followed by a really small candlestick, and then a longer candlestick again that starts pretty much when the second candlestick ends. Okay, you can see the wick here aligns nicely with the body of our second candlestick. Okay, and for our evening star, we see this bullish candle, followed by that same small candle, and then followed by a similar sized second candle, both of which are bearish. Okay. Next, we have the 3 black crows and the 3 white soldiers that we saw earlier. These are pretty straightforward. Your 3 black crows basically signify that there is a confirmation of a downtrend with prices 3 pretty similar candlestick formations, one after the other, moving in a bearish manner. 3 white soldiers would just be the opposite of that. So you would just have 3 of the same bullish candlestick patterns, one after the other, pretty similar in shape as well. And yeah, basically confirms the strength of the established trend. So for black crows, obviously it's a downtrend. White soldiers will obviously be an uptrend. Okay, so these are more so not so much reversal patterns that we've been talking about for the past few candlestick patterns. These are more so continuation patterns. Okay. Okay, so next we have the 3 inside up and the 3 inside down. Again, this is quite difficult to find, I think, because you have a first candlestick. I think this formation is quite popular, um, and quite difficult to spot. But anyway, we have a first candlestick that's bearish for our 3 inside up, and your second candlestick would start approximately around the same area as the first candlestick that we see here. But it should be shorter. It doesn't have to be exactly like this. Just has to be shorter than the first. And then your last candlestick should start approximately when the body of the candlestick starts as well, the second candlestick. Okay. With 3 inside down, you can see price is once again giving us this bullish candlestick first, since it is a reversal pattern. So it's a bullish candlestick, and then price starts around the same area once again. It's a shorter candlestick, followed by a really long one, that starts again where your second candlestick will end. Okay, so these two are also reversal patterns. Okay. So now let's look at the top 3 reversal patterns. We talked about these briefly last session as well, so I just wanted to do a brief recap. So we first have the head and shoulders. Okay, we have firstly this trend line with that lines up with our swing low here, second swing low, and third swing low. That pretty much categorizes this pattern, and then from the head, price will break out of that ascending trend line and proceed to test that trend line again with the right shoulder, break below this neckline. Yeah, and we are expecting price, once it breaks out of this neckline, to then go in for a sell towards this target here. Okay, so that's the head and shoulders top. Here's the head and shoulders bottom, which are just the opposite of what we were talking about with the top. So here instead of an ascending trend line, we have a descending trend line. The head is, I guess in this case, it's not really a hit since it's a swing low. Um, but yeah, so the hit here, and then once price breaks out of that trend line and retests that trend line from the top, it's then formed a right shoulder. Once it breaks out of that neckline, we then go in for a buy towards that target. Okay, okay. Next let's look at the double top. These are pretty common as well. Okay, do you want me to go back to this one? Okay. Yes. Okay. Um, so the one that we were talking about are the head and shoulders bottom, which is basically the bullish version of your head and shoulders top. Again, prices are moving in a descending trend line at first. Once it breaks out of it, that's where your neckline is formed. Retest that trend line, forms your right shoulder. Once it breaks out of that neckline, then we go in for a buy towards this target level here. So your target level would be typically anywhere below this neckline, or in this case, above the neckline. Um, yeah, it can be anywhere from here, can be this swing low as well, but obviously if your target, um, your risk reward ratio is greater, you will want your target to be a little bit further away if you are certain that price is going to continue upwards to reach your target. Okay, so that would be the opposite of this, the top, which you are going in for a sell towards that target. But again, the concept is the same. You're going in only when price breaks out of this neckline, going in for a sell towards a target that's way below this swing low as well. Okay, it could even go below your former um your original price. Just make sure that you're certain that price is actually gonna reach your target. Okay, next let's quickly look at your double top. So for your double top, these excuse me, basically is a reversal pattern again, formed by two consecutive highs that we see here. We have a swing high 1, swing high 2, and they're kind of about the same level. So if there's a slight difference, that's okay, but they should be about the same level. And an intermediate low, which would be here, as you can see. So it's expected that after the price again reaches the level of the first high, like we see here, um and then it reverses and falls below the level of the intermediate low, then we can expect that the fall will continue further by about the difference between the highs and the lows. Difference between the highs and the lows basically means the peaks here and this low here. That's why you can see our target is way below here, kind of about the same distance as the difference between the peaks and this swing low here. Okay, so this pattern is considered formed when after the appearance of the second peak, which is here, the price or the close falls below this neckline. So again, your neckline will be over here. And the dotted horizontal line, which you see here, ends with the target label, and it indicates the expected price level after the pattern has been formed. So as new bars appear, the line extends to the right until the last bar, until the pattern status changes from awaiting to another. which basically means that here we are waiting for price to reach our target, but you can expect price to continue moving to the right here. So once it reaches your target, then we'll be waiting for another of one of these patterns. Okay, any questions? All good. Okay, next let's look at the opposite of that, which would just be a double bottom. So it's pretty similar. Again, we have, instead of swing highs, here we have swing lows with, again, they should be kind of approximately the same, the same height. Okay, so they should kind of be about the same height, between these two levels and between your swing low here. So this is what we call our intermediate low. So your target, again, would be about the same distance here. If you count the boxes, right, from the neckline to your target, you can see it's 1, 2, 3, 4, 5. Your height of the bottoms here, 1, 2, 3, 4, 5. So it's kind of about the same distance. Okay, that's where you should place your target profit. Okay, do you guys have any questions? So basically, how you find this formation, we're just going through how to spot the formations and where you should place your target, or your take profit levels after you've been able to spot them. That's basically all this webinar is. Okay. Okay, let's move on to our next candlestick pattern. So next we have our triple top. So okay, so your triple top pattern basically shows that price has tested this resistance level since we have three swing highs testing this level, but price has been unable to penetrate this area, where the peaks are at. So if we are talking about in a real life context, it basically means that after multiple attempts, the asset or your security or your currency, whatever it is that you are trading, is unable to find that many buyers in that same area or in that price range. So as the price falls, which we see here, recent pullback low and the trend line, when it falls, it then puts pressure on all the traders who bought during this pattern to then start selling. So if the price can't rise above that resistance, then there is limited profit potential in holding onto it, obviously. So as the price falls below the swing lows here, as it falls below it, selling might escalate as former buyers exit losing long positions and new traders, excuse me, and new traders jump into short positions like we see here. Okay, so that's kind of the psychology behind the pattern that we have here. Okay, so there are times when a triple top, like we see here, when it'll form and then it'll complete. So then traders might believe that the asset will continue to fall after it breaks below this pullback. But the price might then recover and then move back to that resistance area. Okay, so for protection, a trader could place a stop loss on short positions above the latest peak or above a recent swing high within the pattern. So one of the swing highs here, for example, could work. And then This move basically limits the risk of the trade if the price doesn't drop and instead rallies. So here we see a very significant drop after the swing, after your triple top, but that might not happen. So that's why we place our stop loss on short positions above that latest peak, which would be somewhere here or maybe here as well. Okay, so I guess same thing with a triple bottom. It's pretty much the same concept. We have our triple bottoms here. Price breaks out of that neckline. And then we go in for our take profit over here because it's a confirmation that price is going to continue to rise. Similarly, like over here, once it pushes below this swing low, then it's confirmation that price is going to drop. So that's why here it's the opposite. So that's why we're going for a buy towards our take profit here. Remember, your take profit should always be kind of after that neckline. So it could be somewhere at this previous swing high. Just as long as it's past that neckline, it's fine. So one of the drawbacks of these triple patterns, and that's pretty similar to your double tops and bottoms as well, that we talked about previously, is that the risk and reward ratio is a drawback on these patterns. So since both the stop loss and the target are based on the height of your pattern, so your height is basically here. Height is basically the height of your swing. Here would be swing lows. Previously would then be your swing highs. So the height of your pattern, you can see they are roughly equal. So patterns in which your potential profit is greater than the risk would of course be most preferred since your risk to reward ratio would be greater. So instead of doing that, you can place the stop loss within the pattern. So within this pattern, instead of above it, or I guess in this case would be below it, and this would improve the reward relative to the risk. Okay, of course, this also depends on where your entry points are, where you get in once this formation has been formed. But yeah, normally your risk would be somewhere after this triple bottom, and your take profit, as long as it's beyond this neckline, you should be fine. Okay, any questions so far on our reversals? There are a lot of sources out there. If you just search up chart patterns or candlestick patterns, a lot of websites will go through this pretty in depth as well. So if you're still confused after this, feel free to just check that out or look at the recording of this webinar, which again, I think if you email IronFX, they'll be happy to help you out. Okay, let's look at our top 3 breakout chart patterns. Firstly, we'll be looking at our falling wedge, then our bullish rectangle, and then our bullish pennant. Okay, so starting off with our falling wedge, this is where we would roughly place your take profit entry and stop loss levels. I guess these are also kind of your triangles, or I think, yeah, it would be your triangles as well. So in this case, a falling wedge would just be a descending triangle. So the upper line, which we see here, basically matches or it connects the lower highs to the bottom line. When I say lower highs, I mean because there is a swing high here, here, and here, but price is making the swing highs are lower each time. That's basically what I mean by lower highs. Okay. So an ascending triangle, which we see here, or an ascending wedge, you can see it's moving, it's kind of just the opposite of this, with price making higher lows. And then we have the upper level, which is kind of just following price. So it is still moving upwards, but not at the same level as our bottom line. Okay, so for your ascending triangle here, the upper line will go through most of the equal highs, so it doesn't have to go through all. And your lower line just has to connect all of the lows. So it's just the opposite of this shape here. Take profit would be above that higher swing high rather. Your entry would be somewhere in the middle here, and your stop loss just has to be below this lower line. So it would be the same thing, just opposite for your ascending triangle. Stop loss would be on the top, entry would be somewhere here in between. Past this should be maybe here, okay, and then your take profit um just above it over here. Okay. So normally with an ascending triangle, traders will buy when the price breaks above that upper line. And in a descending formation or a falling wedge, like we see here, they wait for price to fall below that lower line here. Okay. Yeah, stop loss, take profit. We've already gone through that. Okay, let's move on. So next we have a bullish rectangle. So these, I think another name for this is the flags. So for flags, I think it signals a trend continuation. So here on our screenshot from TradingView, we have in ascending rectangle. Okay, here we have kind of a symmetrical. Again, it's bullish as well since price is moving in an uptrend. And flags consist of the flag itself and the flagpole. Flagpole is just this line here. So of course, if it's a bearish flag, would just be the opposite. It'd just be coming down in a downtrend. So they are normally framed with two trend lines, where in a bullish flag, like we see here, they will connect the lower highs, okay, which is here, the lower highs and the lower lows. And in a bearish flag, it'll just connect the higher highs and the higher lows, since it'll be the opposite of this. So to spot the pattern in a price chart, you kind of just have to wait for a strong price movement, followed by a move in the opposite direction, like we see here. Okay, so these kind of rectangle or flag shapes signal a trend continuation. So in this case, since it's a bullish rectangle, we would then continue to buy in a bullish trend um, when the price rises above the flag's upper boundary. Upper boundary basically means this line here. Once it raises above the triple swing highs here. Or if we're looking at the price chart, as long as it raises above this swing high. Okay, so for your stop loss, we would normally recommend you to place it below the lower band of your formation. Your entry, as we mentioned earlier, would just be as long as it breaks above that upper line, and your take profit would just be anywhere above it. Okay. Okay, next let's talk about the bullish pennant. So pennants it basically combines the features of a symmetrical triangle that we talked about earlier, or the wedge that we talked about earlier, with the features of the flag pattern. So you can see it has the shape of a symmetrical triangle, but the profit targets, which you can see this kind of flag formation based on the length of like the flagpole or the uptrend. Okay, so the pennant again is a continuation pattern. So that appears during a short-term consolidation within a strong trend. So if you're able to identify it in a bullish trend, like we see here, it's most likely to break above its upper boundary here and continue rising. So if you see it as a bearish pennant, of course, it would be we're going to expect it to break out of the bottom boundary and continue to fall. Okay, so on spotting a pennant in a downtrend, which we don't have here, traders usually will sell on a breakout of a lower line. Here we see bullish pennants, so they will usually buy as soon as the price breaks above this line here. Okay, we would normally place your stop loss just below that lower boundary again, so similar to the flag. Entry would be as long as it breaks out of the upper boundary, and your take profit would just be anywhere above those levels. Okay, but it is kind of supposed to be an equal length that's recommended. So equal length between the beginning of the movement, so it can be the flagpole here, as well as the movement from here to your take profit, or whenever price breaks out of that upper boundary. Yeah, you're right. They are really similar. It's just this bullish pattern is just a combination of the triangle as well as your flag. So the main difference between it is just this flagpole thing that we have here, which basically tells you the uptrend and the downtrend. So this is kind of a confirmation, I guess, of an uptrend happening. Whereas if we go back and look at our wedge, right? I mean, I guess here we also have that flagpole in this animation. But if you actually look at the price, we don't really um have that flagpole. It just straight away starts as the bottom line and your upper line. Okay, but yeah, they are pretty similar. There aren't that many rules when it comes to this. I guess I wouldn't call it rules, it's just more of being able to spot these formations. So if you just Google, I think like um I guess this would be breakout patterns. So if you just Google um breakout patterns, these should come up. And there are a lot, so don't worry if you don't get it straight away or if you're not able to remember all of them. We're only going through the top to use for now. There are others on the market as well, so feel free to just check those out. Okay, so now let's look at combining candlestick patterns with what we already know. Okay, so we're gonna start off with support and resistance since this is basically the foundation of everything. So I did briefly talk about your overlap resistance levels earlier. But basically what we want to talk about is being able to spot significant swing highs and lows. So for example, here we have an insignificant swing. So these are bad points to use for Fibonacci. Not just Fibonacci, but any kind of analysis as well. So this is the kind of shape that we want to be looking for with significant moves up and down. Okay, here's another example. So I've drawn out exactly how clear your peaks and troughs should be. Again, you want to make sure that your levels um kind of line up with at least 2 swing highs or swing lows so that it's more significant. You can, I guess, because these levels, you can see that price has already tested these levels in the past multiple times, so these are more significant levels to use. Okay, and this applies for both your entry and your take profit levels as well. Okay, so now let's look at combining what we know. So your pullback and overlap levels, um, like this. Okay, so in this first example, we have a big swing high resistance level. Price surpasses this big swing high level and becomes a pullback support where we expect price to pull back or retrace back to that level. So in the green areas, we see price retrace this level and bounce off of it perfectly. And once price bounces off the pullback support, it then becomes an overlap support. Okay, another example here. So with 2 swing highs lining up, we have a swing high resistance. Price has surpassed this level and has become a pullback support. So we can expect price to retrace back to this level and take note of the blue circles here since price bounces off this level twice, making it a really strong overlap support. Okay, and our last example here, there are multiple swing lows that are in line with that 33420 support level. Once price breaks this level, it then becomes a pullback resistance. And we can see price has tested this level 3 times over here, making it a strong overlap resistance level. Once price actually breaks out of it at point number 4, we can see it becoming a pullback support. And then once it bounces off again, it becomes an overlap support. So all of these levels combined with your ability to spot candlestick formations and also with your trend lines, trend channels, and indicators will help you to form, as well as Fibonacci. Those will help you to form confluence and help with your analysis. Okay, so just to recap, a valid trend line is when there are at least 3 touches on it. Like here we see at least 3. Here you can combine all of this with your channels as well, like we did earlier. And yes, so just to recap again, for channels, valid channels, you want to make sure that it touches at least twice on top and twice below. Here we have more than twice. Here we have more than twice, but as long as it touches at least twice, that's good enough. And of course, next is combining these with resistance and Ichimoku as well. Okay, that's all for my webinar today. Thank you guys so much for joining me. I hope you guys found this session helpful. And yeah, thank you guys so much. If you guys like me, feel free to connect with me on LinkedIn. It's just my name, Melanie Chong. And yeah, I'll see you guys again next week. Thanks, everyone. Bye.